Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company.
All this week, it's our holiday tribute to charitable giving. And on today's show, charitable gifts and taxation. And with me today is certified financial planner and nationally recognized charitable giving expert, Dan Nagito. Happy holidays, everyone. I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to the show, Dan.
Thanks, Steve.
We're talking with Dan Nagito. I love this book because it's kind of like your roadmap. If you've never done this before, The Power of Leveraging the Charitable Remainder Trust. And if you go out to his site, you can pick this book up. It's really good reading. And I think if you're really thinking about charitable giving, this is the way to go. We're talking about taxes because I know yesterday we talked about heart, desire, passion for one's charity, as long as it's approved, IRS approved charity.
Yep.
But today I want to talk about taxation because, there are some good reasons to do this. And we are, a lot of times I always think, and as I said yesterday, Dan, I'm always into the mode of, it's the end of the year. And it does happen, but you do this all year long.
Oh, yeah. And, the thing about taxes, what I said yesterday was it starts in the heart, winds up in the stomach. I believe that the stomach is what drives the tax issue because you get, as we say in Italian, agita from paying too much in income tax, capital gains tax, whatever, tax on dividends. So you want to have some kind of, it's nice that a charitable giving gives you some kind of tax incentive to give to charity as well as just getting a benefit of your heart.
Well, I'm looking at, the basic taxation of a charitable gift annuity, because that's kind of one that everybody kind of like, hey, I need to dip my toe. What's the introduction to this? And I'm looking at this of a person giving $100,000, age of the beneficiary 75, and the payout rate's about 5.8%. And there's a couple caveats to that, of course. That's going to be paid quarterly.
Right.
Now, when I'm looking at the federal rate at 1.4, I'm not sure it's really 1.4 now, but we're just using this as an example.
Right.
To walk me through the mechanics of that a little bit, because I'm kind of interested in how did this actually work? What do I get as a giver? Okay,
we talked about yesterday the fact that this really works better at the older age markets. And you can see why. I'm going to give the charity $100,000. Now, I'm going to get an income tax deduction for giving that gift to charity. I don't see that deduction is on here, but that's okay. I'm going to get some kind of deduction for giving my gift to charity. I'm 75 years old, and I'm getting a 5.8% payout return back from that $100,000. Now, that's a great example right there of I can't get 5.8% income on anything. A CD right now is, 0.0 something, 1. So here I can get a 5.8% return, and the AFR, the applicable federal rate, is the rate that the government assumes that you could earn if you invested your money over, a 10-year period. So I'm going to get $5,800 of income paid to me for the first 12 and a half years. Of that, I'm only going to pay income tax on $1,100 of that. And that's the beautiful part of a charitable gift annuity is I'm going to get $5,800 of income back to me, but $4,600 of that is considered to be return of principal, so that's not taxable. And there is no long-term capital gain on that. So it's ordinary income and exempt income. And look, if you're 75 years old and you can afford to put $100,000 up, you're probably at the age where you're pulling money out of your IRA, your pension plan, and your income level is popping up. You expected to retire, and your tax deductions were going to increase, or your tax deduction would increase, your taxable income would decrease. But now you're in this world where we're paying tax all the time on everything. Well, you want to shelter some of that income. So now you're getting $5,800, of which only $4,600 of that is non-taxable. Only $1,100 of that is tax exempt. That's a pretty cool place to be.
What about this? So, let's say this was a stock contribution and had basis of 50 grand. I notice the numbers say relatively the same. The exempt income goes down, and my long-term capital gain goes over to this other company. Why is that occurring?
Because when you can't use charity as a total tax dodge. You have to account for the avoidance of capital gains tax one way or another. Now, when I put stock into give stock to a charity, I'm getting my deduction is based upon the value of the stock today. The charity can sell that and you pay no capital gains on the sale of that stock. But here they're giving you your income stream back. So they're going to account. Now, what's good, it drops your it keeps your ordinary income where it was, $1,100. Unfortunately, it drops your exempt income because you have avoided some capital gains tax on that on half that money, $50,000. So what I wind up is having to amortizing the capital gain over the life of my income stream.
So this is a lifetime income stream based on, this would be higher if this client was older, right?
Yeah.
Those mortality credits would bring that number up. Now,
Oh, here it is. I'm sorry, I'm going to interrupt you, but that's what I do. The donor will receive a current income tax deduction of 41.8. I was concerned because I was saying, wait, this graph isn't right. So this is very cool because what happens is I'm going to give you $100,000. Now, I'm trading off the fact that I have no more control over that money. But I'm going to give my alma mater $100,000. I'm going to get a tax deduction of $41,000
for that year?
for that year.
Okay.
Okay. And I could use that against 30% of my adjusted gross income, and I can carry that forward for 5 additional years if I can't use it all. Now, I'm going to give you that. I'm going to get tax deduction $41,000, and I'm also going to get $5,800 of income, and that income of $4,600 of that's going to be tax exempt, or in this scenario, it's going to be spread out between ordinary income, tax exempt income, and long-term capital gain.
Okay, I like the idea that I'm getting a deduction up front and I'm getting tax advantaged income along the side, even if it's stock.
Yeah, it's a great situation.
And we come back from the break, we're going to talk about the charitable income tax deductions your clients can use. And don't forget, you can go out to Dan's site and buy his book, The Power of Leveraging the Charitable Remainder Trust, right on his site at www.najito.com. And while you're out there, why don't you sign up for the 30-day free trial offer from Backroom Technician? Just go out to brtnow.com/trialsignup.aspx. We'll be right back after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back, everyone. I'm Steve Savant with Dan Najito, and remember, you can watch all our episodes of Let's Get Down to Business and my weekly consumer show, Steve Savant's Money, the name of the game, right out at ashbrokerage.com. Just click on the show logo right on the homepage. And just a heads up, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, as well as your broker-dealer compliance officer. Well, let's get down to business. We're talking about charitable income tax deductions. Well, Dan, I want to talk a little bit about some of the types and so forth. You know, I like to get the math. I understand that. I love the deduction things we talked about. But does it matter what type of charity we're talking about on some of this? I mean,
Yeah, well, it matters what type of charity and what type of asset. There's two parts to this. If the biggest tax deduction you get is when you give cash to a public charity. That's the biggest one. That's when you write your check for $1,000, you take it off your income tax.
It's gone.
It's gone. It's
Right.
gone. Public charities are 501c3 organizations, and they have to serve for the public benefit, general public use. You could take that $1,000 contribution, you take it off your income tax, and yes, that's fully deductible. You don't deduct $1,000. You deduct $1,000 against up to 50% of your adjusted gross income. But that's pretty rich. That's the biggest deduction you get. When you give gifts of appreciated stock to a trust, for example, a charitable remainder trust, then that drops down to a gift of 30% against your adjusted gross income. When you give a gift of stock to a public charity, then you can write that gift off. So I can have a gift of $50,000 block of appreciated stock. I give that stock to the charity, public charity. My tax deduction is based upon the value of the stock on the date I give it.
So it's $100,000. I give it that day.
Right, it's $100,000. Even though my basis may only be 50, my gift is based upon $100,000.
So I'm writing $100,000 that year.
And I get to take that. I get to take it that year. And again, I can use it against 50% of my adjusted gross income. And if I can't use it all, I can carry it forward
For 5 years.
for 5 years.
Okay, now this is important, a little distinction, because We make the deduction. I may not be able to use it all that year, but I can carry it forward for
right.
5 years. Okay,
right.
I kind of like that.
Yeah, and a lot of people love that. Now, if I can also give that same stock to my own charitable remainder trust. Now, remember that first gift, it goes to charity. I'm giving the stock. Goodbye, IBM. Okay. The second one, I'm giving the IBM stock to my own charitable remainder trust, which will someday go to charity. Now, for that one, I still can get my gift valued at the date of the gift, value of the stock on the date of the gift, $100,000. I still get my income tax deduction, but it's watered down now because it's not going to go to charity for a few years. I can take that $100,000 against 30% of my adjusted gross income, and I can carry that forward for 5 years.
Okay, so make sure I understand. So in this scenario, 30% is what my write-off is going to be, it sounds like?
I'm going to be able to take my write-off against 30%.
But then I'm taking income now.
Taking income, and and here's the payoff, I can still sell that stock inside that trust and avoid the tax on capital gains.
How powerful is it to have the control and to do what you just said?
I think that's enormous because, again, if I just want to give the money away, I'm going to give the money away. Right. That's fine. But for people who are on the brink and they're not sure what they want to improve their income stream, perhaps, this is the ideal situation because I can give that stock to the charitable trust, get my tax deduction, sell it, avoid the tax on capital gains, and still get an increased income stream. I can call my shots. I can be my own trustee. I can reinvest that money going forward. I mean, it's a lot of control. It's very flexible, even though it's in a irrevocable box called the Charitable Remainder Trust. So I'm a little off the subject of charitable deductions, but you get where I'm going with on this thing. It's a very, very cool tool.
Well, I like it because you've kind of mapped out here as we were talking here some of the limitations of our annual charitable deduction, and you have the 50% limit, the 30, and the 20. When we look at this, it's going to be when we look at these numbers, it's going to be based on the asset itself, and it's also going to be based on are we giving it away or are we also taking in an income? If I've understood you correctly.
That's correct.
Now, when you see this, what is your tendency? Because you do this all the time, all year round.
Right.
What is the if I'm a regular person, what am I doing? And then my second question will be, what if I'm an affluent person? What am I doing? Because this is all about taxes here.
Yeah. Well, a regular person, whatever that is, a regular person. If you're going to write a check, you're going to write a check. It's that could be someone who wants to give a $25 gift or a $250,000 gift. It's just a gift,
and it's done.
And it's gone. But the real fun happens at the more affluent levels because these are people who not only want to take care of their charity, but they want to take care of their families too. And those kind of gifts, that's where you can, using charitable trusts, and you're reducing your tax deduction to 30% of your adjusted gross income, but I'm avoiding the tax on capital gain, I'm keeping income, and then I think on one show later this week, we're going to talk about how to replace that income using insurance. I mean, you can't get any better than that.
So I can split this up between my charity, my own income, and my own heirs.
Yes.
Well, see, that's what I think people don't know that. I think when they think they give it, it's gone. There's some techniques and some ideas that have tax ramifications that could be very positive, and it depends. I could have heirs, income for myself, and my charity getting blessed all at the same time.
That's why you got to read my book.
I'm reading it, and that's something. I appreciate that. That to me is where I think a lot of Americans are looking to go to this idea where how can I do all three?
Right.
Well, that's our show for today. Remember, you can read all my online news commentary, advisor blogs, and articles on Producers Web, as well as my answers to consumer questions on the Insurance Library. You can also view all our past episodes on our on-demand section located at downtobusiness.ashbrokerage.com. So follow me on Twitter, Facebook, and LinkedIn, or just email me, steves.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. Happy holidays, everyone.